Good afternoon. The following presentation is on Glass-Steagall and Dodd-Frank. It will be presented by Team 6, Alec Lydon, Hannah Morris, Noli Paquet, and Walter Malcolm. The Glass-Steagall Act was passed by the U.S. Congress as part of the Banking Act of 1933. In a nutshell, it prohibited commercial banks from participating in the investment banking business and vice versa. Its two primary objectives were to stop the unprecedented run on banks and to restore confidence in the U.S. banking system, in addition to sever the linkages between banking and investing activities. The reason for the separation was the conflict of interest that arose when banks invested in securities with their own assets, which were in most cases the assets of their account holders. So to combat this, separating banking business from investing business would prevent banks from providing loans that would boost the prices of securities in which they had risk, using depositors' money to underwrite stock offerings or funds, or persuading clients to make investments that served the institution's interests but went against the individuals. From the start, there was always backlash against the Glass-Steagall Act. However, there weren't any significant strides until the early 1980s. As a result of the rise of the giant financial services firms, a roaring stock market leading up to the dot-com bubble, and a strong anti-regulatory stance at the Federal Reserve and in the White House, there was a strong argument that led to a partial repeal in 1999 by the Graham, Leach, and Bliley Act. They say partially because the act targeted a specific section of the Glass-Steagall Act, Section 20, which limited commercial banks' activities with their assets.
The Volcker Rule was proposed by Federal Reserve Chairman Paul Volcker. The Volcker Rule prohibits banks from using customer deposits for their own profit, which ultimately protects bank customers. It also won't let them own, invest in, or sponsor hedge funds, private equity funds, or other trading operations for their own use. It protects depositors from the types of speculative investments that led to the 2008 financial crisis. The rule is in Section 619 of the Dodd-Frank Wall Street Reform Act of 2010. The Volcker Rule is not meant to be a catch-all to eradicate risk, but rather to discourage excessive risk-taking. The Volcker Rule allows trading in two circumstances. Banks can trade when it is necessary to run their business. This includes underwriting, hedging, and trading if it is to limit their own risk. And also, banks may also act as an agent, broker, or custodian for their customers. Banks cannot engage in any trading activities that create substantial risk. They cannot expose the bank itself to high-risk trades. Most of all, they cannot generate instability to the U.S. financial system. The Volcker Rule discourages banks from taking too much risk by barring them from using their own funds to make these type of investments to increase profits. Congress passed Dodd-Frank and the Volcker Rule in 2010. It gave the job of developing the law into specific regulations to a commission of 5 agencies. They continue to oversee the regulations today. These 5 agencies include the Federal Reserve, Securities and Exchange Commission, Federal Deposit and Insurance Corporation, Commodities Future Trading Commission, and the Office of the Comptroller of the Currency. The Volcker Rule went into effect in April of 2014 and has been enforced since July 21, 2015. The Volcker Rule sets to undo the damage done when Congress repealed the Glass-Steagall Act in 1999, and to re-establish the divide between commercial banking and investment banking.
The Dodd-Frank Act was in response to the financial crisis that became known as the Great Recession. Dodd-Frank put regulations on the financial industry and created programs to stop mortgage companies and lenders from taking advantage of consumers. The law places strict regulations on lenders and banks in an effort to protect consumers and prevent another all-out economic recession. Dodd-Frank also created several new agencies to oversee the regulatory process and implement certain changes. This was created in 2008 due to the Great Recession, as I previously have stated. It was signed into law on July 21st, 2010. It was more towards the larger banks because of the saying, too big to fail. Moving on to the next slide, Dodd-Frank Act trigger and impact on small and large banks. Beginning with large banks, they have the impact of preventing risky business practices that ultimately hurt consumers, increased capital level requirements, and became stricter because of the regulations that were implemented. Small banks increased compliance costs, eliminated products/services, and issued fewer loans. The products and services are things as in mortgage servicing, overdraft protections, and lines of credit. They had to issue fewer loans due to the increased compliance costs. Because of that, the community banks had to keep up with the compliance costs and lessen their ability to earn rates of return that can cover these costs. As a result, this has forced many smaller banks to consolidate with larger banks and increase the competitive advantage larger banks have in comparison to smaller banks. Banks are required to come up with plans for a quick shutdown if they approach bankruptcy or run out of money. Financial institutions must increase the amount of money they hold in reserve to account for future slumps. Every bank with more than $50 billion of assets must take an annual stress test given by the Federal Reserve, which can help determine if the institution could survive a financial crisis.
The Dodd-Frank Act uses regulatory requirements such as Section 165 to limit excess exposure of unnecessary risk. Section 165 was created to mitigate risks to the financial stability of the United States that may arise from financial distress. Furthermore, a risk committee must approve and randomly review risk management policies of a company. The committee uses 5 elements to determine the risk of a given company. First, Dodd-Frank mandates policies and procedures for risk management control. Second, it requires systems to monitor compliance with these policies. Third, liquidity risk must be established to record risk limits and acceptable collateral for counterparties. Fourth, the risk committee must be an independent board committee. Finally, a minimum of 1 member of the committee must be well experienced in assessing the risk of a company. Continuing, the Chief Risk Officer, or CRO, is one of, if not the most important positions in determining the risk of a company. The CRO's responsibility is to report to the board's risk committee and participate in key decisions for an individual company. Finally, when deciding the risk of a company, internal controls must be established to monitor the institution. With 2 principles governing internal controls, a banking institution must first demonstrate that its system is appropriate for the size, strategy, and risk appetite of the company. Second, and finally, it must evaluate the effectiveness of the internal controls on an ongoing basis to limit system failure. The Dodd-Frank Act on trigger and impact of capitalization has made numerous changes to the banking structure to make institutions more resilient to financial stress events. The Act based its requirements similar to Basel III capital standards by raising the capital requirements on bank holding companies with more than $50 billion in assets under management. While gauging the impacts of individual factors on economic growth is difficult,
Research shows that increased capital requirements have shown positive impacts on the economy. Stephen Sacchetti, an American economist, has found that companies were able to increase their capital when accepting smaller return on assets, cutting net interest margins, and reducing overall operating costs. Furthermore, banks will be required to hold more liquid capital to ensure that they are not over-leveraged.